Before coins and paper money, taxes were already a fact of life, because governments formed before modern markets did. In the earliest cities, the tax return looked like a sack of grain, a jar of oil or livestock driven toward a temple storehouse, while scribes recorded who paid and who didn't. The point wasn't elegance, it was survival and control, food for soldiers, reserves for drought, supplies for building projects, and the earliest tax systems taxed what could be counted and stored. From the beginning, taxation was tied to power. When officials collected tribute in public with guards nearby, the message was simple: the ruler can enforce a claim on your output. That's one of the oldest truths about taxes. They're not only a financial tool, they're a political tool. Whoever sets the rules for what is owed and who gets exemptions defines who carries the burden of the state. As societies grew, rulers learned that you can't tax what you can't measure, so measurement became governance. Censuses, counting people and property, weren't just statistics. They were a way to turn a population into a revenue base. Once the state can count you, it can plan around you, how much money it can raise, how many soldiers it can draft, and how tightly it can enforce compliance. In the medieval world and beyond, taxes often appeared at choke points, bridges, city gates, and trade routes. Merchants had to pass through narrow corridors where guards could stop them, inspect goods, and demand payment. This pattern repeats across history because it's practical. Collection is easier when you can't go around the collector without great cost. That practical logic becomes a rule you can almost treat like gravity. Governments lean toward taxing what is visible, stable, and hard to hide. Land can't disappear overnight. A house sits in the same place. A shipment must pass through a port. These are easy targets, not because they're morally right, but because enforcement is efficient. And tax systems, over time, evolve toward what can be enforced at scale. In colonial America, that enforcement logic arrived on wooden docks. Customs duties, taxes on imported goods, were a core revenue source for empires because trade funnels through ports. Crates and barrels could be counted, ships could be inspected, and merchants could be pressured. For ordinary colonists, these taxes weren't abstract. They were built into the price of daily life and the rhythm of commerce. Paperwork became its own kind of control. When Britain imposed measures like stamp requirements, it wasn't only the cost that angered people. It was the idea that legal and commercial life could be taxed and regulated from afar. Taxes started to represent something larger than revenue: who had authority, whose interests were prioritized, and whether the governed had a meaningful say. The Boston Tea Party is remembered as a dramatic scene, but what made it historically powerful was what it symbolized: a fight over legitimacy. The tea wasn't just tea, it was policy. People were rejecting a system where taxes were imposed without representation, where revenue collection felt like domination, and where compliance became a test of submission rather than citizenship. That conflict spilled into meetings, pamphlets, and public debate, the messy human side of public finance. Here is another truth about taxes. They are never merely technical. They are social agreements. And when people believe the agreement is unfair or imposed, tax resistance becomes a form of political speech. Revolutions often have many causes, but taxation is a recurring spark because it touches everyone. After independence, the young United States didn't start with the modern income tax as its main engine. The federal government leaned heavily on tariffs and certain excise taxes because they were straightforward to collect. In a nation still building administrative capacity, taxing trade through ports and taxing specific goods was simpler than trying to measure everyone's income across a vast rural country. But even early on, Americans saw the tension between a government's need for revenue and the public's tolerance for how it's raised. The Whiskey Rebellion showed how a tax can feel targeted, especially when it lands on a product that functions like a local currency and a livelihood. The lesson was old and repeating. A tax may be legal, but if it's seen as unjust or disconnected from people's realities, it can provoke serious backlash. The first U.S. income taxes arrived the way they so often arrive in history: through war. The Civil War demanded funding beyond what tariffs and excises could cover, so income taxes were introduced as emergency measures. This pattern, major conflict expanding the state's revenue tools, shows up again and again because war creates a financial urgency that forces governments to modernize collection. As America industrialized, wealth became more concentrated and more visible in city skylines, corporate fortunes, and sprawling estates. Inequality wasn't new, but it was changing form, shifting from land-based power to industrial and financial power. And whenever wealth changes form, tax debates follow, because the public starts asking the same questions in a new context. Who benefits most from the system, and who is paying for it? In 1913, the 16th Amendment set the stage for the modern federal income tax. At first, it was not designed as a mass tax on the middle class. It was aimed higher up the income ladder, reflecting progressive-era beliefs that a modern nation could ask more from those with greater ability to pay. But what a tax is meant to be and what it becomes over time are often different stories. The idea of progressive taxation, higher rates at higher incomes, became a defining feature of the federal income tax. Yet the detail most people miss is that progressivity depends on what you count. Are you looking only at federal income tax, or at payroll taxes, sales taxes, property taxes, excise taxes, and fees? A system can be progressive in one layer and regressive in another, and real life happens in the total. World War II transformed the scale of federal taxation. Funding a global war required enormous, steady revenue, and the income tax expanded from something many households barely touched into something that reached deep into the working and middle classes. This is one of the central turning points in U.S. tax history, the creation of a broad, dependable tax base tied to ordinary earnings. Then came the mechanism that made the system extraordinarily effective: withholding. Instead of relying on people to set money aside and pay later, the government shifted collection to the moment wages are paid. The paycheck became the collection point, and the employer became the pipeline. This is why employees pay first, because, structurally, they do. Once you see that, the lived experience of taxation makes more sense. A worker goes to work, earns wages, and taxes are removed before that worker makes a single choice. There's no clever timing, no special structure, no waiting for a better year. The system is designed for certainty, and wage income offers that certainty better than almost anything else. Payroll taxes added another powerful layer. Social Security and Medicare are funded largely through taxes tied directly to work, collected per paycheck, and difficult to avoid for regular employees. For many households, payroll taxes represent one of the largest portions of total taxes paid, and they apply regardless of whether someone owes much federal income tax after deductions and credits. Property taxes reveal the visibility rule again. A home is a major middle-class asset, and it sits in plain sight. Local governments can assess it, bill it, and enforce collection in ways that are hard to escape. And because property taxes don't care whether your income fell this year, they can feel especially heavy during downturns or personal hardship. Sales taxes make the burden even more immediate. Every time money is spent on taxable goods, a slice is taken at the register. This tends to hit lower-income households harder as a share of income because they spend a larger percentage of what they earn just to live. Even if two households pay the same sales tax rate, the sacrifice can be wildly unequal. Now the story splits into two Americas: the employee and the owner. Employees live inside a system of automatic reporting, W-2s, withholding payroll taxes, where income is documented and captured as it flows. Business owners and investors can have more levers. When income is recognized, what expenses are deductible, and how money moves through entities. That doesn't automatically mean wrongdoing. It means different kinds of income come with different control. This is where the difference between wages and capital becomes central. Wages are taxed as ordinary income, and the system treats them like a stream that can be measured and tapped continuously. Long-term investment gains and qualified dividends often receive preferential treatment, meaning the rate applied to those returns can be lower than the rate applied to labor. That difference is a major reason wealth can compound faster at the top. Even more important than the rate is the timing. If you earn a wage today, it's taxable today. But if an asset you own rises in value, your stock, your company, your real estate, that increase is usually not taxed at the moment it happens. In the U.S., tax often waits for realization, meaning a sale. So a person can become much richer on paper without triggering an immediate tax bill. That timing difference is the foundation of one of the most famous wealthy person playbooks, Buy, Borrow, Die. It starts with buying assets that are likely to appreciate. Then, instead of selling and paying capital gains tax, the owner borrows against those assets. Loans are generally not considered taxable income, so borrowing can convert wealth into spendable cash without the same tax consequences as selling. This is how you can see a very wealthy lifestyle alongside surprisingly low taxable income in a given year. Spending can be financed by borrowing, while the owner holds onto assets that keep appreciating. The tax system is built to tax transactions and realized income more than silent appreciation, so the wealthy can sometimes choose when, if ever, they trigger the tax event. Real estate adds another layer through depreciation, which can create paper losses. Depreciation allows an owner to deduct a portion of a building's value over time as an expense, even if the property is generating positive cash flow. The result can be a situation where the investment feels profitable in reality, but looks less profitable, or even loss-making on a tax return, depending on the details and applicable rules. For certain real estate transactions, tools like 1031 exchanges can defer capital gains tax when proceeds are rolled into a new property under specific requirements. The key word is defer. Deferral is valuable because it keeps more capital invested and compounding. Over long periods, deferral can be almost as powerful as a rate cut because it changes the math of growth. Charitable giving can also be highly tax efficient, especially when the wealthy donate appreciated assets. Donating stock that has risen in value can allow a donor to support a cause while potentially avoiding capital gains, tax that would have been owed upon sale, and also receiving a deduction subject to limitations. This can be driven by genuine philanthropy, but it's also undeniably a planning tool within the system. Finally, complexity itself becomes an advantage. The tax code is not a single clean rule. It's layers of policy written over decades, full of exceptions, definitions, and special treatments. People with money can hire accountants and attorneys to legally shape income, deductions, timing, and structure, while employees mostly live with whatever shows up on the pay stub. That's why the system can be simultaneously true in two ways. The rich often pay enormous dollar amounts in taxes, yet they can still pay lower effective rates on how wealth grows, and they can sometimes make taxable income look small compared to the reality of rising net worth. If you really learned something from this video, do well to like the video and share it with your loved ones. And if you enjoy lessons that help you build wealth, subscribe to Rich Mindset for more powerful lessons on creating financial freedom.